Disney is a company that I know a lot of you, if not all of you, are very familiar with what they do and what their business is about. But I wanted to do a recap on their business, its performance, and analyze their stock and valuation. And as always, guys, give you my overview and thoughts on this stock at the end of the video. Hello guys, welcome to another video. If you're new to my channel, then welcome. Please go and subscribe, smash the like button for the YouTube algorithm, and follow me on my Instagram. Disney is a company that, in my opinion, is very diversified. They are in the network and production industry with ABC, ESPN, Marvel, Lucasfilm, the History Channel, Pixar, Lifetime, 21st Century Fox, National Geographic, 67% of Hulu, A&E, and last but not least, their very new, most popular project, Disney+. Then they own all these theme parks and resorts around the world in Florida, Tokyo, Paris, California, Hong Kong, and Shanghai. And also they are in the cruise line industry with 4 ships that operates in North America and Europe. Since it's a very diversified company, Disney is a long-term foundational stock. This is a company that has been around for decades with its magic, and in my opinion, it's impossible to see it disappear in the long run. The company is always spending a lot of money on transitions and improvement to be able to adapt to any new change throughout newer generations. If you're familiar with the stock by itself, you know that it was a slow-moving stock since 2016, before breaking out last year when they announced their new service, Disney+. All this happened because ESPN, which was Disney's most profitable cable channel, lost 7 million subscribers in 2 years, being the lowest subscribers in total in almost a decade. All that led to a cost-cutting move which led to laying off roughly 100 ESPN employees. As we can see here, Disney has underperformed the S&P 500 in the last 5 years, being down 8.87%, right after being almost 40% up before all this crazy virus situation started. All that negativity was reflected in the stock, and it ended at the exact moment when they announced Disney Plus on April 2019, where their stock went up more than 10% in a day, getting to its all-time high. Then, on November of 2019, executives stated that they picked up 10 million subscribers within a day after it launched. As of April 2020, they have 50 million paid subscribers, but it's important to know that a lot of those subscribers came through a partnership with Verizon, which offered a free year of Disney Plus to their customers. It's not guaranteed that those customers that got Disney Plus because of the partnership will resubscribe as paying customers when the free trial ends, but still, 50 million subscribers is a crazy amount. They actually expected to get 60 to 90 million paid subscribers by 2024, and having already 50 million in 2020 is insane. It took Netflix 16 years to get to 15 million. Obviously, I know those were way different times, but this gives us a perspective of how this industry has changed and also how people's interest in entertainment has also changed. Disney has a market cap of approximately $182 billion and a PE of 17. This stock has been trading at an average PE of 17.88 in the last 5 years. This means that investors are expecting Disney to have an income proportional of what they've been having lately. Now, let's get to their fundamentals. They had an increase of 17% in revenue year over year from 2018 to 2019. This increase was due to several reasons, including Disney's acquisition of Comcast's 1/3 stake in Hulu, higher guest spendings at their theme parks and resorts, and their 21st Century Fox acquisition. This was an incredible revenue growth in comparison of previous years because, as you can see here, they had a growth on 2016 of 6%, then down 1% on 2017, up 8% on 2018, and then 17% on 2019. Take into consideration that revenue of 2019 does not include Disney Plus, since they reported earnings on October and Disney Plus came live on November. Analysts are expecting them to have an increase in revenue for 2020 in the lows again by 5.64%. Even though now they will be counting Disney Plus, remember they got hit really hard because of the virus situation, since they needed to stop operations in all their parks, resorts, and cruises, and also had to delay all their movies that were going to release this year. leaving them with revenue only for the online services. But before all this situation, analysts were expecting them to actually grow another 17% this year, 2020, which will create a massive loss for the company. Even if they were to open their theme parks, their attendance is not expected to be as huge as they were until the second half of 2021, affecting their profitability of theme parks even more. Their Q1 2020 earnings report, which was way before all the virus situation, showed us that in comparison of Q1 of 2018, they actually grew 24% in media networks, which include cable networks like National Geographic and ESPN, and broadcasting services like A&E and ABC Studio. Also increased 8% on parks, experiences, and productions, which, as the name says it, includes their theme parks, resorts, and cruises. Then 106.4% increase in studio entertainment, which includes all the movies that they created like Frozen or Star Wars. And last but not least, 334% growth in direct-to-consumer and international, which includes Disney+, Hulu, and ESPN+. It's important to know that they had an increase of 375.4% in their paid subscribers for ESPN+, and 29% for Hulu. The thing is that their revenue for those platforms actually decreased because they started offering a bundle offering Disney+, ESPN, and Hulu for only $12.99, lowering ESPN Plus and Hulu membership price. But I do expect a huge demand for this new bundle. Their Fox acquisition left them with a weak balance sheet with a current asset to liability ratio of 0.8. Still, they have a total debt to asset ratio of 0.52, which is actually very good. Obviously, it's a bit worrying when you see that they have a long-term debt of $38 billion. But they currently have $6.8 billion in cash and enter into 4 different credit agreements, which increase Disney's current liquidity of $24 billion. That amount of money is more than enough to service its debt for the next 2 years. Disney also offers a dividend of 1.72% and has a payout ratio of 50%. Now, analysts are expecting them to have a decrease in earnings per share of 42.40% for this year 2020, which it could actually be a little bit higher decrease depending on how all this virus situation ends, and then increase back again 45% next year 2021. According to 24 different analysts, they have a price forecast for the stock as low as $100, which is 2.2% decrease, and as high as $175, which is a 71% increase. If you ask me, I don't see Netflix at $170 within a year. I think that price is way too high when they might not be able to open their theme parks for the whole year, unless something very huge happens to the company, but still, it will be very difficult for them to get to those levels. I don't like to speculate, but that is my opinion. Another important thing that has happened recently is that their 15-year CEO decided to retire as a CEO on December of 2019. After that announcement came public, a lot of people started to wonder as well about why he really left. Not only that, but also that after some weeks, he decided to return and work as a chief executive in the company again. Now, I'm saying all this because with a new CEO, we would have to wait and see what his expectations and future plans are for the company, what he's planning to do to be able to go back to normal and continue being one of the most favorite companies for long-term investors. Right now, there are a lot of reasons to buy this stock and also a lot of reasons to sell due to their current risks. I do own these stocks at the moment and I'm not planning to sell it, but again, that's me and I'm not a financial advisor, so I'm going to give you guys different reasons of why it's a good stock and why not. First, Disney bought 21st Century Fox last year, and that is expected to help the company strengthen its TV side national and internationally. Also, Disney Studio has a huge lineup of movies to be released between this year and next year. Another reason to buy Disney is because they released Disney Plus last year, which we have already seen a huge growth in it. Now, reasons to sell or not buy Disney at all. First, they are investing very heavy on ESPN Plus and Disney Plus in operations, marketing, and technology, which could hurt their international sector's profitability. Second, we would have to see how many of those paid subscribers that are using the free trial offered by Verizon actually decided to resubscribe to the platform. And also, it's obvious that Disney Plus is facing a huge competition from Netflix and Amazon Prime. Now, in the short term, I'm not bullish in this company at all because of everything that is happening and the uncertainty of when they will be able to fully reopen their operations. In the long term, I do think that they are a very solid company, as they have always been. And I believe they will be able to sustain and then come back even better than before. I expect the company to go with the market. I do not see this company outperforming the S&P 500 in the short and middle term, but maybe in the long term they will be able to. It all depends how they manage this situation. That was all for this video, guys. Thank you for watching. Go and check out my last stock analysis videos that are live in my channel. Don't forget to subscribe, smash the like button for the YouTube algorithm, and follow me on my Instagram. Stay safe, stay home. Thank you, and see you next time. Now, the worst thing is that they might not reopen their theme parks until 2021, which will create a massive, which will create. Now, reasons to sell or not buy Disney at all. Disney.